All right. Good afternoon, everyone. Thank you so much for joining us today. I'm really excited about our guest speaker. Today's topic will be the new 2021 State of the Union for real estate investors. Is it going to be an implosion or the next, or is it going to be an opportunity next? There you go. So a few things before we get started. NuView, we are non-fiduciary. It is really up to you as a client, the self-directed IRA client, to do your own due diligence and figure out if that investment is something you want to invest your money into. So we are not attorneys, we're not CPAs, we're not tax advisors. We're very knowledgeable when it comes to self-directed IRAs. So we can guide you in the right direction, but we always suggest you speak with your attorney, CPA, or tax advisor before making any investment decisions. And just a little bit more background on NuView. If you're new and it's your first time joining us, NuView's been in business since 2003. We custody 1.7 billion in client assets now. And our operations office is located, that's in the picture right there, outside of Orlando, Florida and Longwood, Florida. So we have about 10,000 clients. And the few things I do take pride in is the fact that we are simple to do business with. We are available and we are responsive. We will answer the phone when you call. 98% of the time is our average. A lot of times we hit 100%. Not a lot of companies can say that they do that. So that's one of our biggest points, is that we like to be able to answer the phone with a live person for you. So I'm really excited about our guest speaker. If you joined us on our virtual conference about 2 months ago, you would have saw him. We got great feedback and we were excited to bring him. His name is Dave Stech. He's a real estate market timer and investor, private lender, and an angel investor. So Dave graduated from the London School of Economics. He speaks at Harvard Business School and other conferences where he shares his State of the Union for real estate investors and entrepreneurs. One of the biggest topics is where are we now and what's coming next? And his investing in short-term rentals. Also, another topic he discusses is the new State of the Union for early stage and tech investors, private equity, and venture capitalists. So Dave heads the Stech family office with his two sons, one of which is the founding partner of the largest private lender in America, valued at over $1 billion. And their family office invests in three main things. That's real estate, private lending, and early stage technology companies. So Dave built his wealth by leveraging Roth self-directed IRAs, and he teaches others the power of using a Roth as well. So with that, Dave, it's all yours. Take it away.
Boy, I sure appreciate it. That was a great introduction, better than I could have done, I can tell you that. All right, well, let me share my screen real quick, Brian, and please tell me that you can see it when I go full screen here. And if so, I'm good to go. All right. All right, well, let me do one thing real quick just to make sure that I'm good to go, and then we'll start. Well, thank you again, Brian. We're going to get into really the meat and potatoes of what's going on in real estate now and what you might consider doing about it. And I call it my 2021 State of the Union for real estate investors and private lenders. And the question everyone's asking themselves is it an opportunity in 2021 or is it potential implosion? Well, just as you heard a disclaimer from Brian, before I start, I'll simply say, I'm not an attorney. I'm not an accountant. I don't play one on TV. I'm not soliciting or offering any securities in this webinar. It's simply to update you on the current economic and housing market so you can be a better informed investor. That's it. There's nothing for sale. You can simply cheat off me. You can cheat off our research. You can borrow our strategies, whatever you'd like. Deal? Well, it should be, because the only thing you're going to be responsible for are your own decisions. Seek professional advice anytime it affects you, your future, your family, your money, and your health. And health has come up recently, as in the last year, hasn't it? Where we've all been a little concerned about what's coming next. Well, there's other things to be concerned about, like the economy and the housing market. And so if all of those things are of concern to you, which they should be, make sure to write down what you see there. accessinsiders.com/NuView, and we'll add you to our alerts. We'll add you to our free research reports. We'll do everything that we can to help you get to where you're trying to go quicker and navigate the uncertainty that we're in right now. So Again, accessinsiders.com/NuView. I share that so that you don't all email me because there's 300 of you on today's call. So welcome from stay-at-home paradise. What do I mean by that? Well, that's the view that I look at every day from my balcony here on the nicest 1-mile stretch of beach in the Caribbean with, as you can see, roughly 7 layers of aquamarine, and it's the middle of winter. Actually, it's getting near the end of winter, but that's what I've been looking at all winter. And some of you might be back to living life normally, but for me, that's the view I've had for the last 13 months. The good news is I make double-digit interest income as a private lender every minute of every day, and I pay a flat 4% corporate tax. In addition to that, of course, investing out of my self-directed Roth allows me to pay 0 tax. But of course, I've got to look at that every day. So it's not an easy situation, but for over 6 years now, I've been doing it. I'm actually in my 7th year in Puerto Rico. I also want to thank you know who, the folks from NuView who brought us all together today. And that would be Grace Nelson and Jason DeBono and Brian Martinez. Together, the 3 of us have spent a fair amount of time on the phone trying to strategize how our research and everything we do within our Stech family office could actually help you. And as it turns out, they asked me to share my new 2021 State of the Union for real estate investors and private lenders, which is why we're here today, all 300 or so of us. And I do hope that this helps you to start thinking and, more importantly, doing in 2021. You see, this year it's time to thrive, not just survive. So thank Grace, thank Jason, thank Brian. And why? Because recognition feeds the soul. They didn't have to invite me and I didn't have to be here, but I'm here to help them and by extension you. And yes, in 2019, I forecasted a 2020 recession. Well, there could have been a number of things that triggered that, but it turned out that the one thing that triggered it was COVID. And it turns out that I've been doing this for the last 15 years since my first presentation at Harvard in 2005. Where I told everyone, based on all my research and hundreds of slides worth of support, to get out of the market. Well, no one believed me. I almost got thrown out of the room and didn't get invited back for 3 years. And in 2008, I said, I'm going all in Las Vegas. Well, if you remember, Las Vegas was the #1 place you didn't want to be. It was the foreclosure capital of America, if not the world. And so I got thrown out of that room. And in 2011, I was introduced as the guy that told them in 2005 to get out and to get in Las Vegas in 2008. So what did I think now? Well, in 2011, I believed everyone should go all in everywhere. We were about to enter a phase within the next 12-month period where we'd have the best cash flow and the best appreciation potential in our lifetimes. And sure enough, we've been on a 9-year tear, as all of us know. So where are we today? Well, let's get into the economic update. I always thank, just like when I thank our folks at NuView, I like to thank the folks that support us in terms of the private and the public research that we have to pay for and get access to because it's invaluable. The first thing I'm going to share with you is something that may surprise you. 17% of Americans are concerned about losing their job in the next 12 months. That's right. You may think that everything is behind us, but not all Americans believe that that's the case. 1 out of every 5 Americans think things are likely to get worse and are concerned about the impact that it's going to have on them. Therefore, the government continues to pile on new stimulus. The stimulus timeline you can see is as follows. The PPP or Payment Protection Program is now available, the 3rd version of it, but you have to have greater than a 25% decrease in revenue to benefit from it. There's, of course, the stimulus checks, which I don't receive, but I hope many of you do, between $1,400 and $2,800. There's the unemployment, which of course has recently had a booster. There's student loan deferral that continues to get extended. And it's the one area that's growing the fastest in terms of debt as a percentage of gross domestic product. Mortgage forbearances, are getting kicked down the road. You have to understand that forbearance is not forgiveness. It just means it's delaying payments for a little longer. So that's been banned through June. And rent forbearance, where there's $25 billion in rental assistance to basically extend the eviction ban. So at the end of the day, we've got an awful lot of money that's being put into the market, and it's coming in the form of liquidity. And the question is, where's it going and what's it doing for us? Well, all told, the 3 COVID stimulus packages that we've had so far add up to $5 trillion, or get this, 23% of our 2019 gross domestic product before COVID. How crazy is that? Well, COVID stimulus is 4 times the amount of money that was spent to address the global financial crisis back in 2007 through 2009. 4 times more than then, and we all know what happened there. After a net loss of jobs in December, we're back in the black for January and February. Soon we'll have March results. But at the end of the day, a good chunk of the hiring came in the hospitality sector, thankfully, which had been the largest hit category. So there were 280,000 new jobs. Only the information sector saw a decline, and a very modest one at that. Jobless rate dropped to 6% in March. And before you start celebrating, know that that's what's called headline unemployment. If you look at the adjusted unemployment numbers, it's 9.4%. So what's the difference? Well, there's 4.3 million people who actually left the labor force entirely as a result of COVID. And for now, they're casualties of COVID because they decided not to come back to work. So they're like everyone else filing for unemployment. And we've still got a long ways to go. Only 56% of lost jobs have been recovered. So when we look to 2021 this year, and we look at job growth forecasted, Moody's is projecting about a 1.7% job growth increase. The consensus is about 2.7. That's generally 60 well thought of economists who are weighing in. And I think it could actually be better. I think it could actually be 3.3% because we've started from such a low base. And despite all these job losses, disposable personal income increased by $1 trillion in 2020. You see, if you look at wages, they were impacted by about $43 billion, but the government provided $499 billion in stimulus in the form of unemployment insurance benefits, another $276 billion worth of those $1,400 and $2,800 checks they were issuing. Then the PPP program, which would have been sharply negative, actually pumped in another $29 billion into the economy. And all other income increased $265 billion. So total disposable personal income increased by $1 trillion. How do you define a trillion? A lot of money. Well, in parallel with that significant increase of $1 trillion, spending actually decreased. So if you look at the amount of money spent on durable goods like home equipment and other things, $60 billion was spent. On non-durable goods, like I'm going to cook in tonight rather than eat out, another $39 billion. But look at all of the reduction in spending that took place in the consumer segment. $575 billion worth of services were not spent, no one spent money on. Plus the interest payments that were less because of the reduction in the interest rate. So at the end of the day, total household outlays are $535 billion less as a result of COVID. So what does that mean total? Well, net, Americans are saving. And not only are they saving a little, they're saving a lot. Because if you look at total disposable personal income going up by $1 trillion and discretionary spending going down by over $0.5 trillion, Americans' personal savings went up $1.5 trillion, which is an increase of 173%, almost a tripling of savings. Well, that's not what the government's anticipating when they do a stimulus program. They want it to go back into consumer spending in order to help small businesses and big businesses. Well, personal income shot up again in January due to new stimulus checks. So savings deposits jumped more. And now they're up $2.5 trillion from February of last year before COVID just to June. And the personal savings rate increased to over 20% in January once the new stimulus checks came out. Now, where would you expect that all that extra savings is going? You think it's going into a bank? Well, over 70% of round one stimulus checks went to either saving or to pay down debt, which is not what the government would prefer that you do. Now, anyone who's smart did exactly what you did. You paid down debt, or you put the money in the bank because of the uncertainty that you don't know what's coming next. That would be the smart thing to do. Of course, in our case, we believe we know what's coming next because we spend a fortune on research to figure this out. By a 10% margin, more Americans say their income is significantly higher than significantly lower because they're feeling the positive impact of stimulus. And some households, unfortunately, are not working because they benefited more from stimulus by being unemployed. The share of Americans who expect their financial situation to worsen is mostly flat through the first quarter of this year. And a lot of the money is ending up in the financial markets, but not the way you think it would end up. It turns out that the dollar value of money market mutual fund assets peaked in May of 5.3 at $5.3 trillion. And what do you think was the average annual yield for account holders in 2020? So if you've got your money in a money market fund, what do you think it's earning in 2020? Any sense? How about 0.07%? That's 0.07 of 1%. So here's a quick question. What do you think you'd earn if you had $10,000 in a money market? What would you earn at that rate for a year? $7. So no one is getting rich, but everyone is doing it because it's better than zero and it's better than not having money in an uncertain time. US consumers continue to cut back on their credit card balances as well. Revolving credit is down 12% from the same time last year, which is a record drop. And consumers' interest in borrowing money keeps dropping, which is what's positively impacting interest rates. So banks now have extra balance sheet capacity. Americans' confidence in the economy is up from January, but it's still below the average index. Basically, it's still considerably worse than pre-COVID because Americans just aren't sold on things coming back to normal. By a 14% margin, more Americans say the economy's on the wrong track rather than the right track. Think about that. From 37 to 51%, over half of Americans now believe that the economy's on the wrong track. So the trillion-dollar question is, what are we going to see in the form of inflation? Well, let me answer that for you with a question to you. What percentage of all US dollars in existence were printed just in calendar year 2020? What percentage of all US dollars in existence were printed in 2020? Now, you may not have the answer, but just take a guess. How about 20%? You realize 20% of all the money in circulation was printed in the last year? That is crazy. Post-vaccine, inflation is likely to rear its head due to the pent-up desire to spend, because during COVID, life for most households was non-inflationary because they had limited outlets for consumption. But post-vaccine, the pent-up desire to make up for lost time could lead to a flood of discretionary spending for an extended period of time. Asset managers have decreased their net short positions in the US dollar. So that basically means that asset managers are becoming somewhat less concerned about the US dollar being devalued. The 10-year Treasury yield has started to climb. It's currently at 1.6%, which is a 13-month high. And why is that important to you and me? because as the Treasury yield goes up, a rise in 30-year mortgage rate activity could likely happen. Well, we're already seeing some increases in interest rate, not wild increases, but increases north of 3% instead of south of 3%. And states with overall lower tax rates are actually benefiting from corporate relocations. You can see the 10 best business tax climates and where people are moving to in blue, and the 10 worst business tax climates where people are moving from. Not surprisingly, New York, California are the biggest ones. Well, the US added a net 1.5 million electricity customers year over year. And why should you care about that? Well, it basically means there's strong household formation, which is good for you and I if we're real estate investors and private lenders. So let's segue then into a housing market update. And of course, I went quick on the economy, and I'm going to go quick when it comes to the housing market update, but I think you're getting the picture, and that is what I'm hoping for. There has been a meteoric surge in pending sales, and it's continuing. Pending sales are up 65% year over year, and 59% of pending sales are under contract within 14 days. The number of new listings shot up big time starting in March. It's currently 26% year over year. And unit sales are climbing with the spring buying season. They're now up 16% year over year. So total, and this is important, and it's why I underlined it, months of supply is down to just 1.1 month, a 58% drop year over year from last year. And inventory in units now, before it was months supply, now this is units, keeps dropping as well. So nearly all major markets have less existing home inventory than they had a year ago, 42% less on average. Now, why do you see a couple of arrows there? One to San Francisco and one to San Diego. Well, we're market timers, and we saw something coming in San Francisco that led to my youngest son putting his home, he had a very expensive home in downtown San Francisco, putting it on the market in May and basically selling it. And when I say putting it on the market, not on MLS, but calling the broker he bought it from and saying, I'm ready to sell. Before it hit MLS, he sold it and moved out of San Francisco to San Diego. So my message here is timing is the most important word in real estate. It's not appreciation. It's not cash flow. It's timing. Because Josh moved in July from the market with the highest increase in inventory of 49% to the US market with one of the highest decreases in inventory, 52%. Now, I said at the time it was an 84-point swing because that was the month before and I didn't update it. But as you can see, it's a 101-point swing. So he got out at the right time and in at the right time in another market. He put it under contract late May, closed July 20th before this change. And that's really important. Median list price is up 18% year over year. Look at the slope of that line since March. How crazy is that? And median sale price is up over $50,000 and 17% year over year. Now, does any of this make sense to you? Homes are appreciating across all major markets, and California has 5 of the top 10 markets. Sorry about the horn in the background, but I had to move into a different room because of the storm we're having in Puerto Rico right now. Sellers are getting just over 100% of their asking price on average. Think of that. When's the last time that all sellers got more than they listed their homes for, even if they were overpriced? Here's a case in point. I'm a private lender. I did a profit share deal with a flipper, and the deal took too long because it was in St. Petersburg, Florida, where permitting is painful. It just takes way too long. So I funded this deal in January of 2020. I provided a $188,000 loan out of my self-directed Roth IRA, and I loaned $45,000 for the rehab. So a $233,000 loan on a 950 square foot home. Now look at the front. You see that light blue door and that gray sort of facade? Well, that used to be a porch, and that porch was 160 square feet, which got converted to usable, livable space as part of the home. So that made it an 1,110 square foot home. And the ARV, the after repair value, was 310,000. We estimated in January of 2020. And so I did a loan at 75% loan to value. Well, as I mentioned, we had permitting issues and therefore delays through no fault of the flipper, just trying to get approval during COVID and getting approval in a place that's difficult anyway. Well, it didn't get listed until January of 2021. We got 2 offers on the same day and more to follow, and ended up accepting an all-cash offer of $347,500, which basically meant I'd loaned at 62% of loan to value because the value was a lot higher than I thought in the first place. So my return into my self-directed Roth was $61,000 gain, or a 26% cash on cash return. Now, why am I telling you that story? Because 12% of this, in my opinion, was related to the market tailwind from COVID. And the other 14% was related to the way I structured it with what I call preferred minimum returns and profit escalators. So I don't lose when things go long or when things go wrong. And so I structure private lending deals the way you should if you're at all interested in private lending. And we actually have a workshop where we teach other people to do that, but that's not the point of this. It's called Just Be the Bank. If you want to go to justbethebank.com, you can provide us your information and we'll send you information. 63% of home buyers made at least one sight unseen offer in 2020. Think of that. 63% of home buyers made one sight unseen offer at least in 2020. Well, 82% of markets now are between strong and very strong. And we've been tracking for a long time, actually 20 years now. And so there have been many times where everything was in the very weak to weak category, and now everything's in the strong to very strong, 82%. Now, all buyer segments are in very strong territory, but it wasn't always like that. In February 2020, before COVID, things were very strong, except in the empty nester segment. And there, in that active adult space, it was normal. But boy, did it turn quickly to very slow. And it stayed very slow until we started figuring out in May what was going to happen. And then we started going all in again. And sure enough, the market came back around, and look at where it is now. So entry level is very strong, and it's the first to show strength. Move up, very strong, led by buyers seeking more space. Luxury and second home, very strong. And it's recently started to surge as the stock market's improved and mortgage rates remained low for high-end homes. And active adult, very strong. It's a softer part of the market, especially at the onset of the pandemic, because we know what was happening to the elderly in terms of their death rates. The net share of Americans who say it's a good time to buy is up 8% from February, whereas the net percent of those who say it's a good time to sell shot up 13% from February. Affordability will surge past our historical norm once interest rates rise at any meaningful level. And as you can see, they've started to rise. So affordability is a function of 3 things: sales price, which of course is going through the roof, interest rates, which are going through the, well, not going through the roof, but increasing. And so with sales prices going up, things are less affordable. With interest rates going up, the ability to finance higher prices is less affordable. So it's like the double whammy. And income, which is the third element of affordability, can't go up fast enough. So 2/3 of people would prefer to buy versus rent if they were going to move, because they're excited about owning a home right now, especially in a COVID environment where they'd rather own than rent. Interest rates for 30-year fixed rates rose to 3.17% in March, now back below 3%. So there was an initial bump, and now most recently they've dropped to just under 3%. So we're hovering right around that 3% mark, which of course is the lowest interest rates in history. After 3 consecutive quarters of increase, originations are expected to drop in Q1. And look at all those refis that have been taking place. And so household mortgage debt, because of these lower interest rates, is the lowest it's been at any point in the last 30 years. Good for you. Good for all consumers and good for all investors who've been refinancing if they could. From a debt to income perspective, you as borrowers or me as a borrower are more qualified than at any time in the last 4 years. You see, if you looked at November of 2016, that was the last time the share of transactions with debt to income was greater than 42%, or that is that the percentage of 42% from a DTI standpoint was so low. Prior to that, you see the share even go lower when you go back to 2013 and 14. But the percentage of borrowers with a debt to income above 42% varies considerably by market. So if you're looking at California and New York, even some areas in Vegas and Orlando or in Florida, you see a third of the cities with the worst DTIs in orange and red, and you see a third of those are in California. Early stage delinquencies continue to stay below pre-pandemic levels. So borrowers with a single missed payment are down 24% and 60-day delinquencies are down 6%. So it's not as bad as you might think it is, although it's considerably higher than it was pre-COVID. So serious delinquencies, that's 90 days or greater, remain 5 times their pre-pandemic levels. And the share of mortgage loans that are in forbearance is down now to 4.2%. Now, 2.6 million homeowners are currently in forbearance, so it's not an insignificant number, but 12% are actually current on their mortgage payment. Foreclosure rates and filings in 2020 were surprisingly less than half of what they were in 2019. But is that so surprising? Of course it's not, because the government stepped in and gave all of the folks who might have been in trouble forbearance opportunities so that payments didn't have to be made and foreclosures didn't get filed. Investors are getting back in the game now after a second quarter slowdown. And now owner occupant properties are driving the show. In other words, retail properties are driving the show. But investor properties, right, those that are buying for investment purposes are growing too, just not as much as homeowners, because homeowners are driven by greed. Well, they're driven largely by uncertain, how do I want to put this? They're not sophisticated. Homeowners are just looking for a home. Investors are looking for a deal. So they're really looking at the numbers. And right now, the numbers are odd. You know, we know that inventory is the lowest it's ever been. We know prices are flying. And it means that the number of deals that are available are very thin compared to what they used to be. And 75% of remote workers expect to have the work from home option after COVID. So will interest or will incomes keep up with home price appreciation and interest rate increases? Well, consider this. With a modest 0.73%, in other words, 3/4 of a percentage point increase in mortgage rates. So say roughly from even the 3.17 that they were at to 3.9, that would mean that if we compared it to a 30% home price appreciation over the same period, home payments would go up 45%. So you can see the impact if interest rates go up and home price appreciation continues to climb. All of a sudden, payments are going to go up by 45, 50%, and people won't be able to afford them. So home price appreciation should be big again this year, and then I expect it to slow as affordability gets worse. Most markets are already undervalued at current interest rates. So you can see in green all of those that are more than 10% below their intrinsic value, which means that they're undervalued. And there are equal number, roughly, that are fairly valued, but there are some markets that are already overvalued because they've been on fire. Well, what if interest rates jumped from 3% to 5%? all 5 major markets would be overvalued, or I should say all but 5 major markets would be overvalued. So the only market that wouldn't be overvalued at a 5% interest rate would be Philadelphia. So in summary, the 2021 economic outlook is largely positive, but it's aided by what I call artificial stimulus. Keep an eye out for inflation as vaccine rollout kicks into high gear and people start their makeup spending. Today's housing market remains very strong because of a lot of things, including work from home, but of course, interest rates and of course, low inventory. Post-COVID new normal, expect some housing industry processes around sales and market and mortgage to permanently shift to more of a virtual environment with consumers saying that's fine. 2021 housing outlook is positive, not just the market, because lack of homes to sell is the biggest risk for home builders, and expect that appreciation until supply catches up with demand or interest rates start impacting demand. I also see, though, increasing risk in the market. Here's why. Capital believes housing is the best investment right now. If you look at housing, it's one of 2 primary bright spots in the market. The other bright spot is anything online or anything digital or anything crypto. Well, stocks and bonds are expensive now. Home prices are rising and rental income beats bond-like returns. Commercial real estate distress isn't over, and capital is going to seek residential opportunities to deploy money that they have. So capital believes housing is the best investment right now. Demand risk is very high. There's a lot more demand than arguably there should have been or would have been had it not been for COVID. It's due to high unemployment and job losses where people feel like they better get a home quickly before someone realizes on their credit report that they're not employed. Congress has been a buffer. The question is, will the latest stimulus work with no consequences? Investor activity is high. Supply risk is moderate. There's not a lot of supply risk. There's millions of mortgages that are in default. Low levels of new home construction generally limits oversupply risk. Affordability, I think it's going to become a problem because booming markets have an affordability problem already, even at what was a 3.17% mortgage rate and has now dropped down to just below 3%. So the expensive gateway markets, those on the coasts, have the same affordability problem they've always had. How much is work from home going to shift those gateway markets, those urban markets, in terms of recovery or not? Is it just going to boost the suburbs and the exurbs? So with all of that economic update, with all of that housing market update, what am I doing? What's my family and I doing that you could do too? Now, why do I put this question at the end? Because if the roles were reversed and I were you, I'd say, wow, love the research. That's amazing. Thank God you're doing it because I couldn't. But what do you do about it? Well, the first thing is you got to choose your target. And I think short-term residential is where you want to be right now, or at least it's where we are. We compared all 3 real estate sectors, industrial, commercial, and residential. And we looked at the 10 real estate subsectors within them. So what did we learn? Well, in industrial, there's factories and plants, and we know that they've been crushed because of social distancing and productivity declines and issues relative to COVID spread. Well, warehouses, they're great if you're an online client, but what if you're offline? Not good at all. So if you have a warehouse and you're renting space, you better have offline clients, or I should say online clients like Amazon. All right, how about commercial? Well, shopping malls, you been to one lately? You planning on going anytime soon? That answer. How about retail? Are you dining out as often as you used to, or are you planning on doing it in the short to medium term? Of course not. How about office? Well, WeWork was the darling that was going to IPO, and now it's collapsed. And Facebook and Twitter and all these other massive companies have announced indefinite work from home. And how about hotel? Well, when's the last time you stayed in one? I haven't for 13 months. I'm staying in my first one in 2 weeks, in over a year. And I used to travel every other week. So are you planning on doing it soon? And are you going to do it as often as before? I'm not. Well, shopping malls and retail and office and hotel are commercial. So is self-storage, which isn't a bad area to be in right now, but will people pay their mortgage payment or their storage payment first? Then you have multifamily. Well, now we're getting into residential. There's single family residential and multi. Well, multifamily is overbuilt. Sorry for those of you who are in multifamily, but it's overbuilt, it's over permitted. And most of the money that used to go into shopping malls or retail or office or hotel are going into multifamily because they don't generally want to own a lot of single family homes and there isn't anywhere else to go. So institutional money is going to multifamily, which is going to exacerbate the issue. So there are going to be some markets where cap rates are going to go in the wrong direction. There are going to be some markets where rent rates start to decline, and it's already starting. Well, then you've got Airbnb rentals. Now we're in the single family space. You know, it's really been a tough year for Airbnb. They laid off 25% of their people, but boy, are they coming back strong and have done an IPO, as you know, that's been off the charts. So that leaves number 10, single family residential. We all know what's going on there because I just told you, and you're seeing it in your own markets. We believe single family residential real estate is the one subsector with the best risk adjusted return in the next 3 to 5 years. And within it, we like short term best, wholesaling, flipping, and private lending to flippers. Now, the reason we like wholesaling and flipping is you can get in, get out, profit, move on. You don't have a lot of uncertainty associated with being in a deal too long. The reason we like lending is not only can you get in, get out, profit, and move on, but it's got the best effort to return ratio on the planet. So if you think of private lending, you think about the 6 F's, or at least you should. In 2005, I first called this the 6F model and at Harvard, and now everybody is using some version of it. The thing about private lending, unlike being a flipper, is you need one skill set, not 6. So as an active investor, the operator, the flipper, you got to find it, you got to figure it, you got to fund it, fix it, fill it, and flip it. That's a lot of work. You work hard because finding it is about marketing and figuring it is about finance and funding it is about raising capital and fixing it is about contracting and construction and filling it is about property management and flipping it is about sales. How many people have all 6 of those skill sets? And if you've only got 5 of them, you can only go as fast as your weakest skill set. Whereas a private lender doesn't work hard, they work smart. All they do is write a check and get a bigger one back. Now, I figured this out in 2011, so 10 years ago. I realized that private lending had the best effort to return ratio of anything in real estate because it met my 12 perfect wants in a business. I want to spend the least amount of time on a deal, have the least amount of expense, have the least amount of brain damage, make the most money, make the most recurring revenue, pay the least in taxes and risk and liability. The point is, I was able to check all the boxes as a private lender, where the active investor couldn't check 2/3 of the boxes. So I took private lending to a new level with my grandsons after I did it with my sons. So there's a certain disqualification. In other words, I'm disqualified from doing deals with my sons and with my grandsons, but my grandsons can do business with their uncle. In other words, they can do a private lending deal together. So it's so simple, a 3-year-old can do it. So what we did for legacy purposes is I wanted to plant the seed of self-reliance and wealth in my grandsons before they could understand it. So at now 4 years old and 1 year old, but at the time of this photo, 3 years old and 1 year old, something like that, or maybe barely 1 year old, I opened up self-directed Roth IRAs. And then I paid them modeling income. You see, they're modeling for me right now. And because I'm able to use them in my advertising as part of my modeling contract with them, they make earned income and they're able to then invest in a self-directed IRA. And oh, by the way, our family works together with their help at 4 and 1 to be able to build what we call outsized returns. Now, wait a minute. They've got a small initial deposit and an amount, right? Of course, you've got to start somewhere. And of course, they couldn't fund a deal, say a $56,000 loan to a flipper, right? Correct, because they can only put a maximum of $6,000 a year into a Roth, but they can be a wrap lender. Now, I know you've probably not heard of it before, and so you're looking at me like I've got two heads, but I'm going to share a quick deal that my grandson, my oldest one, did with his uncle, my other son, a little over 2 months ago. And I'm going to go quick, so watch. Now imagine that there's a 2-bedroom, 1-bath home that a borrower that we were interested in working with, that we had been working with as a family, bought, and it was 768 square feet, built in 1955. It was dated, but it wasn't shabby. They bought it for $50,000, wanted to rehab it for $6,250. They didn't want to make it a beautiful retail property for a sale to a homeowner. They wanted to make it rental grade in order to fix it and flip it as a turnkey investment. That turnkey investment loan amount that we did was $56,000, and they were interested in selling it to one of you who might want to buy it for cash flow because it rented for $1,050 a month. Well, sure enough, they resold it for $75,000. We did the loan, that is my grandson and my other son did it for 2 points and 13% interest for 12 months, although it only turned out to be 95 days. Now, I don't have time to explain this to you. We do this in our Just Be the Bank workshop, but just imagine that my grandson loaned $7,000. My son, his uncle, loaned $49,250. But because of the way that the wrap loan was structured, my son, his uncle, generated a 10.3% annualized return in 95 days, and my grandson generated a 93% annualized return. So how would you like to do that? It's all about taking what the market gives you and learning how to leverage your self-directed Roth IRA in a way that everyone can benefit, especially your family. There's the calculator, and you can see how the money was made. Now, this is a centuries-old legacy formula. This isn't something that I came up with. Private lending has been around forever, but my best example dates back 275 years. There was a boy named Meyer. He was one of 8 kids. He was born in poverty in a Jewish ghetto in Frankfurt, Germany. And at age 13, he secured an apprenticeship with a banker in nearby Hanover, Germany. And it was there he discovered a secret that would change his life and the lives of a lot of families, including many of you on this call if you're doing private lending or want to. He took a secret and over the next decade put it to work. Then he became a father. Then he taught it to his 5 sons like I've taught it to my 2 sons, and then sent them to expand on it in 5 different cities throughout Europe. Now, one of my sons went on to build the largest private lender in America worth over $1 billion. My other son has done incredibly well too, and is the one that did that wrap loan with my grandson. So now my grandsons are doing it. Well, in Meyer's case, 275 years or so ago, he used this to build the greatest international financial dynasty the world's ever known. And today, his family continues to pass that secret from one generation to the next. Their influence and their power in banking and private lending and everything else has reached every corner of the earth. You may have heard of them. They're called the Rothschilds. And their secret, private banking, private lending, something that my sons and I didn't know, but we finally cheated off them. Because in 2011, at a meeting, one guy, Mike from Boston, asked me to do a $175,000 loan that I did from my Roth self-directed IRA and made a 58% annualized return. Now, I'm not telling you that that's normal, but that was my first deal. And I'm looking around thinking, who's going to throw me in jail for this? Well, it's legal and it's a wonderful model. So bottom line is, what should you do about what you learned tonight or today, depending upon when you view this? Well, cheat off me, win the money game. This is the same triangle I drew for my sons over 30 years ago at the kitchen table on a napkin, where I said, sons, in order to win the money game, you got to do 3 things. You got to generate cash, as much income as you can. You got to accumulate wealth, build assets, and build assets that will throw off cash and go up in value. And then keep as much of both as you can. How do you do that? Make sure you don't lose it, and make sure you keep it from being taxed at more than is fair. So no surprise, we do private lending and real estate to generate cash flow. We do private lending to scale business and our wealth. We do real estate from an appreciation and from a leverage standpoint to accumulate wealth. And then we personally invest in early stage technologies, companies, as Brian mentioned at the outset. And those are companies that go up in value. And if you don't know that technology is taking over the world, you should, because the 5 biggest companies in the world now are technology companies. You know them. Alphabet, which is formerly Google, Microsoft, who else? How about Facebook? How about Amazon? The bottom line is even number 6 through 10 is increasingly growing to be technology companies like Netflix. Now, you may be cutting your expenses and taking tax deductions and doing 1031 exchanges, and I applaud you for it. But if you aren't leveraging your Roth self-directed IRA through NuView, and in my case, I live here in Puerto Rico, that's how I'm able to look at that every day, and every day make double-digit passive recurring interest income, regardless of what my active income is, where I'm able to invest it, keep it, and optimize that effort to return ratio I talked about as a private lender, and do it from my backpack. I can travel and be anywhere in the world and generate interest income every day. I haven't written on a piece of paper for I can't tell you how long, because everything is digital now. Everything is DocuSign. All loan documents are created on your laptop. So that's number one, cheat off me. Second, I always provide a free report, which I call my Jerry Maguire epiphany. You remember the movie Jerry Maguire? Well, I literally had one of those as well, where I woke up in the middle of the night because something happened. I wrote it all down, and I'm going to make it available to you in the form of a free report. I don't have a book or a tape or a webinar or a seminar on it. I mean, I could do a webinar, but I'm not selling it. I created it to put my life on a new trajectory. And by extension, you can cheat off me. So it's called The Power of Six, nothing to buy, but my son leveraged it when he went to Stanford. And now we're both leveraging it by creating an Access Insider group of folks like you and folks like us who realize finally that we can do more together than we ever could on our own. That took me about 85% of my life to get it through my thick skull, that I could actually work with others and get to where I was trying to go quicker than I could ever do on my own. So if you haven't figured that out, this would be the time to do it. So if you want that free copy of The Power of Six, if you want the replay of tonight's, or actually today's webinar, and I always call it tonight's because I never know when I'm going to do this, but I know Brian will be sending that out. And if you want to be invited to our future webinars, that is, if you want these market alerts or the State of the Union or the workshop that we do or any of our updates or kind of our alert system, all you have to do is go to accessinsiders.com/NuView. That's it. And for you to not do it would be a massive shame. I don't understand why someone wouldn't do it, to have what has become the largest epiphany of our family's life in The Power of Six, and literally helped my son build a $1 billion company and me build a significant family office. Some people call it an empire. Remember, and maybe you don't know this, I started in a trailer park for the first 20% of my life. And now I haven't spent any of the money I've made over the last 10 years, having done as well as we've done in real estate. So I don't know why you wouldn't do that, but scroll down and fill out some basic info if you do get it, and just complete a couple of questions so we have the information to keep you posted. And if you're serious, not just curious, this would be the time to go to accessinsiders.com/NuView. And lastly, when we do our next Just Be the Bank workshop, I'll register you for it if you submit the information or complete that form that I just mentioned. consider it kind of part two of two. If this was part one, that's probably part two. But as Brian mentioned, I recently did a update on the short-term vacation rental market. I also did the 10-point framework to evaluate an early stage venture deal for those of you who are looking to do it in your self-directed IRAs. We're creating this education for our insiders. Our Access insiders, you know, have asked us for the information on what we do to be wildly successful, and you get it for free. So to summarize, cheat off me, win the money game, be an insider. Go to accessinsiders.com/NuView now. Just tell me a little bit about yourself and I'll send you the Jerry Maguire epiphany. We'll keep you posted when we do webinars like this. Brian will send you the replay and I'll pre-register you for the next webinar when we do it on private lending for those of you who are interested. Now, that's it. Nothing for sale, just trying to help you, as I promised at the beginning, be a better informed investor than you could ever be on your own. So I hope that was helpful. I guess that's the end, other than I'll open it up if Brian wants to ask questions, or maybe it's the beginning. You're going to be the one that chooses. But go to accessinsiders.com/NuView, and I hope I'll see you there. Brian, back to you.
Dave, thank you so much. That was a great presentation, a lot of good information. Just so you guys know, if you didn't hear that, he's predicted a lot of trends that have happened in the market. So, and he does workshops. So if you want to learn more and you want that hands-on training, that's a good way to do it. But we're going to go ahead and dive deep into these Q&A questions. We got lots of questions coming in. If you have questions, please type them in the Q&A portion, not in the chat, and we'll be going down the list. All right, Dave. So are you ready for some questions?
I am. I know you sent me some at the very beginning, and I've been thinking about them, Brian, so I don't screw this up. So I hope I do okay.
All right, let's see. First question here. Any data on appreciation of rent income versus appreciation of home values over the next year?
Yeah, home price appreciation is going to exceed rental price appreciation, and it also depends upon what rental class you're looking at. So multifamily will be slower in rent appreciation than single family will be. And in some markets, rent income will go down in multifamily, where it's unlikely that rents will go down in single family. So just imagine low single digit increases in rents. And right now, over the next 12 months, arguably double digit increases in appreciation.
Okay, next question here. I'm really worried about foreclosures this year. And when do you think it might start to impact us?
Sure, great question. I get it all the time. And I'm going to tell you that it depends upon what the government decides to do. You know, the government has been creating artificial stimulus. They've been forbearing people. As I mentioned in the presentation, forbearance isn't forgiveness. It's just kicking the can down the road. So all the obligations that you have under a forbearance continue with you unless the government decides to tell banks or private lenders or other people that you have to say, it's okay, you don't have to pay me back a portion of your money. I don't anticipate that, but you never know with the new administration what they're going to do. So where does that leave us? Well, it's a wait and see attitude. Here's what I do believe. I don't think it will be as bad as many people think, because one of the solutions to forbearance is a loan modification. And as long as the banks are going to be flexible on modifying loans and simply adding what it is that people haven't paid to the end of the loan, that'll basically continue to kick the can down the road. So the government has allowed for the can to be kicked down the road through forbearance moratoriums. And the banks could kick it down the road if they simply tacked it on to the end of the loan and let people modify their loan.
Very interesting. Just so everyone knows, yes, this recording will be posted on our blog section at nuviewtrust.com. If you click on blog, all of our educational content is always posted there. We usually post the following day before the end of business day. So Fridays, usually in the evening, you'll see the previous day's webinar posted there. So that's where you can find the recording. All right, Dave, next question here. What are the key real estate indicators that someone should keep an eye out and to predict what's coming next?
Yeah, great question again. So what are the big three that I mentioned when we were on webinar? In other words, when I just gave the presentation. The first is sales price. The second is interest rates. And the third is income. Now let's take income first. Income isn't changing much. It's going up a little bit, but nothing significant. The real question is, are you employed or are you unemployed? You see, in the past, when unemployment was so low, we never even asked ourselves a question about unemployment. But now, if you look at the adjusted unemployment rate, where so many Americans are not going back to work because they're basically early retiring or giving up on employment, they've had so much fun they can't take it anymore, or because of those that haven't gone back to work, primarily in the hospitality and entertainment space. All of that means that income isn't going to go up much, but interest rates, they've gone up a little. Now they've corrected and gone down a little bit, but they're at 3%, so that's good news. So what's the bad news? The bad news is prices are going up. Now that's great if you're selling. It's not so great if you're buying, and it's really not great if you're trying to find a home that you can afford. Because remember, those three things, interest rate, sales price, and income, determine and are really the formula for the affordability index. And the affordability index is going in the wrong direction. Things are becoming increasingly less affordable. So those are the three things I would watch for anyone listening. And if there's a fourth one, I'd say inventory. Because inventory and interest rates are driving demand, and interest rates are low primarily because of stimulus. Now people are moving, people are migrating. They're either moving out of offices that they really don't want to work in and don't want to commute to and from, or they're moving out of markets into markets they'd really rather live, because when you work from home, you can be anywhere. How cool is that? So we're seeing migration and we're seeing permanent shifts in terms of what people are doing when it comes to work from home decision making. They're living where they want to live. You know, we always have said as investors, we invest where the markets make sense. Well, they're living where the markets make sense. You know, they'd rather have quality of life in addition to getting quantity of life.
Okay, so how can we leverage a Roth in our 401k plan?
All right, well, that's probably a question better answered by you, but here's what I'll tell you. And by the way, what I'll say is very contrarian, I think, and I'm not going to tell you that NuView 100% supports this, but here's my belief, and that's all it is my belief. I love paper in my self-directed IRA. They won't argue with that. I don't really care for real estate in my IRA. They may disagree with me on that, but why don't I like the possibility of holding real estate in an IRA? Because you could have liability that exceeds the amount of your insurance if there were a slip and fall. And now someone would go right after your self-directed IRA. That can't happen in the mortgage space. If you're doing notes or doing private lending, it's a paper transaction. It's not the ownership of an asset. It's the ownership of paper. So that has been my philosophy. Have I held real estate in my IRA? Yeah, I did. And it was early on in my IRA career, my self-directed IRA career. And for those of you who don't know, this is really important. I used to have a 401k in corporate America when I was in senior management with Kodak and Disney for over 20 years. And when I left corporate America, thank God, and too late, by the way, or I shouldn't have stayed as long. When that happened, a well-meaning friend referred me to his broker at Merrill Lynch. Well, that broker made me broker and took my 401k and turned it into a 201k. And for those of you who've heard me tell this story, I'd be eating special K if he had it right now. And so I was at the right place at the right time. Remember, timing is the most important word in real estate or investing and in life. I was in a seminar where someone stood up in front of the room and said, you should be self-directing your IRA. And I said to the guy next to me, this has got to be illegal. Well, sure enough, it wasn't. That's when I opened a self-directed IRA. I converted my 401k eventually to a Roth IRA in a self-directed format. And now every member of our family has a self-directed Roth, and in some cases, SEPs and 401ks and solo Ks and so on. So Brian and the folks at NuView are probably the best person to answer that question holistically for you, but that's what I believe, that paper has allowed me to grow at a double-digit rate, my self-directed IRA, and not feel like I have to look over my shoulder or worry about tenants or worry about liability. Just don't. So Brian, you've probably got a better answer, but that's mine.
No, that was a great answer and good insight. So everyone's strategy is different. If your 401k is with your current employer, maybe see if that 401k plan allows for post-tax contributions. Usually on the employee contribution side, you can decide if you want that pre or post-tax. That's number one. Number two, you can always, like he mentioned, do a Roth conversion. You definitely want to speak with a CPA first. You don't want that Roth conversion to push you into a higher tax bracket. So that's the way of converting your pre-tax dollars into post-tax money. Would you rather pay your taxes on the contributions to the plan, or would you rather pay the taxes on, a tax deferred type of plan like a traditional IRA? So it really comes down to you and your own strategy and what works best for you. But we can always talk one-on-one. Feel free to reach out to me directly, and I'll talk to you more about how Roth conversions work. We'll move on to the next question. So as a newbie investor, should I look more into flips or buy and holds?
Well, before I answer that, I'll just say one last thing about the previous question. If those of you listening don't have self-directed IRAs, I don't know what to tell you. It's one of the last, what I'd call secrets in terms of accumulating wealth on the planet, because the government continues to take away opportunities for us not to pay tax, or take away opportunities to avoid, not evade, but avoid tax. And so, look, I don't get paid to say this and there's no benefit to me, but I'm just telling you, this is one of our secret weapons when winning the money game, is keeping it. If we can not lose money by making good investments, and if we can keep it by not paying it in taxes when we do make good investments, it's like cheating, only legal. And so take advantage of it until something changes, because it could. Repeat the question, Brian. Sorry about that.
Okay, so
buy and hold versus flip.
Yes, that was
okay. All right. So there are really three things that you can do in real estate within the context of buying properties. One is you can wholesale property, and I'd highly recommend it if you can find a deal. Right now, it's very difficult to find a deal. So if your talent is in finding deals, boy, are you worth a lot of money right now, because everybody wants a deal. Second is flipping a deal. Well, you either have to do the marketing to find the deal, or you market through your network to be able to find the deal. But now you have to do something with that deal, which is called flipping, right? Those 6 F's come into play there. And flipping is a great way to make money. Then there's buy and hold. Well, buy and hold, in my opinion, is the one thing that you do at or near the bottom of the market, because what you're trying to do is anticipate. So in 2010, let me back up. I love this story. It's my favorite story. In 2002, I went under contract on a property in Las Vegas. So imagine that there was a home going to be built, and I went under contract at $109,000 on that property. But it wasn't going to be available until the 4th phase of the development. Well, you know what happened to prices from 2002 to 2006, they took off. And so I contracted at $109,000 at a $500 earnest money deposit. By the time it was time for me to take possession, the property was worth $259,900. That's what the going price was. So what did I do? I assigned it, and I made $151,000 off a $500 investment that I never owned. I just controlled. Oh my God, the light bulb went on. You can literally control real estate and make money. You don't have to own it all, but you can only do that at or near the bottom of the market when the market is bottoming out and it's about to go on a tear. So that $109,000 property, I flipped for $259,000. And then it turned out that the market collapsed, and go figure, this is the oddest circumstance. I bought it back at the auction. What are the chances of that? I bought it back at the auction for $61,764, I think. The one I flipped for $259. And then I bought it, I rented it for 5 years, and I sold it for $175,000. I think it was in 2016. Now, I made over $300,000 on one 1,400 square foot home by taking advantage of market timing, getting in and getting out at the right times. And on 3 different points in the market cycle, I made a collective $60,000 in rent and $240,000, or maybe even more, in appreciation. So for me, cash flow is not my game. It's appreciation and leverage. Leveraged appreciation is how you get filthy, stinking rich. Cash flow is how you earn income to live. And it's the glue that holds the deal together long enough for you to make big money. So I hope you followed what I just said, because it's one of my favorite stories. And one of the ways in which I've just crushed it is by getting in and out at the right times, getting in and out in the right places like Vegas and 14 other markets that we play in, and just really doing well. But cash flow for us is the glue. For everybody else, it's the holy grail. So hopefully that was instructive.
All right. I like this question here. Do you anticipate vacant land to appreciate at the same rate single family homes over the next 2 to 3 years?
Another great question. I didn't expect vacant land to appreciate at the rate that it has. Remember, forecasts are always wrong, no matter whose they are. The only question is, by how much are they off and in which direction? Well, our forecasts are always wrong, but fortunately, we've always been right in the right direction and off by a little. So I expected lots or land to go up in value because there was a shortage of it, but only because there's been an interest because of COVID in new homes versus used homes, and only because there was already a shortage has there been a significant amount of demand in new home space. Now you can literally go to Google and search new home sales versus existing home sales. And that's a form of what's called predictive analytics. And you'll see that more people are searching new homes than they are existing homes, because that's what people want now. As a result, it's driven demand for land. Do I expect it to continue? Yes, as long as interest rates stay low. Because what's happening is building materials are going through the roof. So it's cheaper to rehab a property because you don't need the lumber that's going up at a crazy rate. You don't need all the plywood. You generally need drywall and other things that haven't appreciated or gone up in value as much. So home prices are going to continue to escalate because materials are going to continue to escalate, and the cost of dirt is escalating. So those prices are going to quickly get out of hand. And the difference between the price of a new home and an existing home, delta will increase, and people will start migrating to more of an existing home because they can afford it. Because affordability, as we all talked about just a few minutes ago, is going to go in the wrong direction, not the right direction. So I think land will continue strong for the rest of this year, and we'll see what happens after that. Remember, we're doing these updates that you heard today every quarter. That's why you want to get on our alerts list. So things could change next quarter. Things could change the quarter after that. But why are we doing this? I'm not doing it for you, and I'm not doing it for NuView. I'm doing it so I know what's coming next. And that's why we win 99.9% of the time. We've done over 8,000 deals and lost on 7 of them. Why? Because we know what's coming next. And that has allowed us to be successful. And by extension, when NuView asks me to present this and you join a webinar, you get to cheat off me for no charge, but you get to be added to the list. So make sure to do that.
Do you currently use an LLC within your self-directed IRA to hold paper?
I don't. You could have, an LLC or an IRA
Control.
LLC. Yeah, you could do that. I don't, because I don't feel like I need that additional protection on paper. If I were doing real estate, it would be a different story. I'd probably want a limited liability company that's holding my IRA funds and then be able to loan on real estate. But that's still not something that's impenetrable. But again, I'm not a CPA, I'm not a tax attorney, and I don't play one on TV. I would just say I am less concerned about liability with paper than I am with real estate. And so I don't have an IRA owned LLC.
Interesting. Is private lending, the question is your program subject to UBIT, but I'm assuming they're talking about private lending.
Say that again, Brian.
The question is your program subject to UBIT, unrelated business income tax?
Oh, well, again, I'm not going to talk from a tax standpoint, and Brian and the folks at NuView can answer that. But my program, as you call it, no, it's not subject to UBIT, but my workshop, if that's what you're talking about, is how to be a successful private lender. Whether it's in your IRA or whether it's outside your IRA, it's basically a program or a workshop that we put together because one person asked us to train them. And I said, I'm not going to do it for one person. That one person was in my mastermind group that I was leading at the time. And that group referred 42 of their friends, and we did our first workshop. Never planning on it, but we did it. And now we're doing our 9th workshop this weekend. So the workshop is about how to be a successful private lender. If you do it within a self-directed IRA like we do, you can, and you can certainly do it without having UBIT consequences. But I'm not going to be the person to advise you on that. The other thing I would say is keep in mind that as a private lender or as a person listening here, you can either do it with your own money, private lending, either in or outside of your self-directed IRA. Number 2, you can broker loans to other people like me or Brian or someone else that's looking for a loan, and you find the right borrower in the right market with the right deal, and you broker those things. So we teach that as well. And then the third thing you could do is you can do private lending in a fund where you can raise money from other investors, either unaccredited or accredited, depending upon the type of Reg D offering you do. And that's what happened to us. We weren't trying to raise money, but we ran out of our own money. And so we learned how to put together a fund. But today you can broker to a lot of companies where you don't literally have to have the money. You can just learn private lending and then broker to someone who has the money. And you know this, Brian. And at the end of the day, there's so many ways to make money in real estate. Bad news is there's so many ways to make money in the real estate. There's so many things you could do, but you've got to be really selective. You've got to think about what you want. And I can tell you, having done almost everything in real estate, that being the bank is a place you have to get to at some point in your career. So we just, recommend you do it sooner rather than later. But that's purely up to you. You can do a lot of things in and outside of your self-directed IRA.
No, I agree. There is so many different things you can do, but you have to figure out what your niche is and focus on that. What I do appreciate about the private lending aspect of things is because you're the bank, you get to negotiate the terms, you have the power. You can even include, custodial fees to be paid for from the borrower. There's a lot of really cool things in private lending, and it's passive. You're not hands-on, you're not a landlord. So you don't have the stresses of those things like owning a piece of real estate. You don't have to screen tenants. You don't have to worry about repairs. Now you still have to do your own due diligence, but that's a whole nother class that you would have to take. But I agree with a lot of things that Dave's saying.
Yeah, and I'll just add this, Brian, because I think it's instructive for everyone. Look, at the end of the day, there's really 3 things you need to do if you're going to be a private lender. You got to vet the borrower, the person you're lending the money to, vet the market, where is the deal, and vet the deal itself. Well, if you're working with a borrower, aren't they going to flip a home and then want to flip another one and another one and another one? Yes, that's how you build a repeat model. And aren't they going to refer you to somebody else like them who's doing homes in a different zip code? Yes. So now you're building a business. And I tell you that because once you build a little business and you vet the borrower once, you don't have to vet them every time you do a deal. When you vet the market once, you don't have to vet them every time you do a deal. You're really then vetting the deal. So you can see how all of a sudden you become much more efficient. And when you do it in a self-directed IRA, now you have tax advantages, whether they're deferred or whether they're free. And so that's pretty cool. And to the point that Brian just made, which is a great one, there are so many ways to make money as a private lender. Points, which you probably know, right? Origination fees. There's interest, which we all understand. There's due diligence fees. There's payoff fees. There's the fees that Brian just made. Or you could even structure it as a profit share and make more money than you could on a debt deal, what's called an equity. That's what profit sharing is, or you can do debt. So look, this isn't a private lending workshop. We can do a private lending webinar, and we have one that we'll invite you to if you're interested. But the point that we're both making, Brian and I, is private lending is a great thing to do, but it's one of many things you can do in real estate. And we just wish you the best, and we want you to crush it no matter what you do.
All right, we have time for 2 more questions here. These questions are more geared towards myself. What are the fees associated with a self-directed IRA? The fees are very small. We only charge fees for any processes that we would do as the custodian. So any manpower, we take 0 commission from any of your investments from your returns. We're not, financial advisors, so we don't take any commission from your returns. It's $50 to open the account. Your annual fee is $295 a year per asset, or you can set it up based on the value of your account. Another question is, where does self-employed folks start from? Well, there are self-employed retirement plans that you can create, such as like a solo 401k plan or a SEP IRA. If you have a small business, there's a simple IRA. Not only that, there's other plans like a health savings account that can be self-directed, or an education savings account that can be self-directed. And the cool thing is you can even partner these different plans together and create, do a note to somebody or do some private lending, and you have more buying power that way, is what we like to call it. So there's so many different plans. Feel free to reach out to me directly, and we can discuss, what plans you'd be eligible for. Now, the Roth, there are some limits to the Roth. There's some income limits. If you exceed a certain amount of money when you file your taxes, then you might not be able to contribute to a Roth, but that doesn't mean you can't do a Roth conversion. So those are more strategies when it comes to building your retirement wealth. And then one more question for you, Dave, here. So this is more and I guess an opinion question here.
Mm-hmm.
Thank you for your wisdom and time to share. Any thoughts or insight on the market in Atlanta?
Well, before I go there, I'm going to say something, because you talked about the fact that you have little to no fees. Well, everyone needs to charge a fee. We all need to make money, and we get it. And kudos to NuView for the way that they've structured their fees. When you're looking at investing, you're either going to do direct investments, where you're going to loan, let's say, to a flipper or buy a home, or you're going to do indirect investments, where you're going to lend, you're going to provide your money to someone else to do their thing and then pay you. So you don't have to do anything other than write the check and get a bigger one back, or get monthly or quarterly cash distributions, or whatever it happens to be. That's something else you got to think about, is what are their management fees? And I know this because we are now putting together our 10th fund, and having done 9 before it, my first one with my kids, and we did in our first fund a 0% management fee. And I told my sons, the reason we're going to do this is because people ought to be paid on results, not on effort. And too many people charge management fees, whether they make money, they lose money, or nothing happens. And that's just wrong. So I tell you that because our management fees are 0%. Now, I'm not asking you to invest with us. I'm saying, when you're looking at a fund manager, if someone like us can take a 0% management fee and only be paid if we can meet or exceed a certain hurdle for you, wouldn't you rather have that? Well, those are the kind of fund managers that we're looking for. If I'm going to invest my money in someone else, I love it when they tell me, I get paid on results, not on effort. I charge 0% management fees, and I'm going to make sure you get paid at a certain level before I even get paid. Is that music to your ears? So that's what we did initially, and that's what you should be looking for in fund managers. So when Brian mentioned fees and them being as low as they are at NuView, that was the first thing I thought of. Is I understand fees. We've all got to make money, but just don't be extorted by people who aren't paid on results. make sure that, or yeah, aren't paid on results. They're simply paid on effort or just having a fund. A fund is nothing more than what somebody can do with your money in order to help you make more money than you would on your own. Now, your question, Brian, please repeat it.
Just what were your thoughts on the Atlanta market?
Oh, okay. So I think the Atlanta market is a great little market. But as with all markets, there are MSAs, those are called metropolitan statistical areas. There are 405 in the US plus its territories like Puerto Rico. Of those 405 markets, there are a lot of counties. There are millions of census tracts. There are all kinds of zip codes. So to say, what do I think of the Atlanta market is like saying, what do I think of the US market? You see, the US market is a sum of all the markets within the US. Atlanta is the sum of Greater Atlanta and Sandy Springs and Dunwoody. I mean, at the end of the day, it's not about some big MSA. It's about the neighborhood and the house that you're looking at. That's what I'm looking at. And we have the capability to drill down to the neighborhood level and look at home price appreciation and rent rates. And it turns out, by the way, within the Atlanta metro, there are some areas that are in the top 5% of all markets in the US for home price appreciation and rent. So when you bundle that whole thing together, we know exactly what zip codes to target on because they'll optimize for appreciation and optimize for rent. And that's how we are able to accumulate wealth when we do a buy and hold strategy at the right time in the right place. Those two things are the single most important thing in real estate.
All right, before we go, where could somebody go to register for the workshop that you teach?
Well, you can go to justbethebank.com, justbethebank.com, or I would really recommend just go to Access Insiders. I think it's probably, I don't know if it's still on the screen, but Access with 2 C's and 2 S's, Insiders with an S on the end, so plural, accessinsiders.com/NuView, NuView. You go there and answer a couple of questions. So we've got your email and your phone number, and we'll just go ahead and alert you anytime we do a workshop, anytime we do a webinar, anytime we do a free research update, all those things you'll benefit from.
All right. Thanks again, Dave. I really appreciate you taking the time out of your day to come educate some of our clients and prospects in here. You always provide a great presentation. We can't wait to have you back. If anybody would like to download our free e-guide, please text SDIRA in caps and your first name and your last name to 484848. If you want to speak with me one-on-one, my contact information is on the bottom of the screen. You can reach me at NuViewTrust.com. There's a little chat bot there, and you can leave me a message, and I'll get back to you as soon as I can. You can email me directly at B for Brian, and my last name is Martinez at NuViewIRA.com, or you can just call me and leave me a voicemail, or like I said, I guarantee I will do my best to answer the phone or get right back to you the same day. My direct phone number, 407-519-9172. Thanks a lot again, Dave. Thank you everyone for joining us, and we'll see you again next time.
And you, thanks again for NuView, and thanks to all of you for listening. Take care.